Good afternoon, everyone, and welcome to Exit Your Firm in Style. My name is Megan Baird, and I'm the Membership Coordinator for AIA Pennsylvania. On behalf of AIA Pennsylvania, I would like to take a moment to thank Keystone Business Transitions for their partnership in supporting our events and creating member value with this webinar. Just a few webinar tips and tricks before we begin. If you're having difficulty hearing this webinar, please select the Raise Your Hand button found in the control panel to the right of the screen. Please feel free to direct your questions to the chat box in the control panel as the webinar progresses. We'll be answering them during the question and answer session at the end of the webinar. Additionally, please keep a lookout in your inbox for a follow-up email containing a link to a quiz post-webinar. AIA Continuing Education Policy mandates that courses administered via webinar must pass a minimum 10-question quiz with an 80% score to receive credit. Additionally, there will be a feedback survey immediately following the webinar. We would appreciate any time you could take to provide your valuable feedback. We want to take a moment to introduce you to today's webinar presenter, Don Feldman. Don is the owner of Keystone Business Transitions and is an exit and succession planning expert. For over 20 years, Don has been working with business owners and their other professional advisors to create and execute exit and succession plans that may include transferring the business to key employees, selling the business to an outsider, or selling the business to family members. Don is a certified exit planning professional and is on the board of standards that sets the requirements for that designation. Don is also an allied member with AIA Pennsylvania, and we are thrilled to have him share his expertise with all of you. So without further ado, I'll hand it over to Don.
Thanks very much, Megan. This is Don Feldman. Let's get started here. So I first want to talk a little bit about the difference between succession planning and exit planning in order to give a little bit more focus to the presentation. Succession planning is something that all businesses need to undertake periodically. The focus is on the business, how to replace key personnel. Every professional service firm has people leaving in the course of time, either through retirement or other types of departures. So there's a need to have people ready to step up into positions of leadership and responsibility. You're constantly undertaking to train your professional staff to better manage projects, develop new clients, and maintain client relationships. That's what I mean by the term succession planning. Exit planning is a little bit different. Here, the focus is on the owner of the business. How long does the owner want to work till departure? After they sell their interest, do they want to continue working in some capacity, or do they want to retire completely? What sort of financial resources does the owner need to retire? What is the value of the firm and the equity interest that the owner has? We need to know that because those are obviously assets that are going to be available to the owner after retirement once those assets are converted to cash. We want to do some tax planning to maximize our after-tax proceeds. And we also need to take steps to ensure the continuing success of the firm. This is important to owners. They want to maintain their legacy in the community and the profession. Also, typically when an owner departs, there's an ongoing financial obligation by which the firm is continuing to make payments to the retiring owner. So we have a vested interest in making sure that that firm is financially strong after the owner retires, and therefore we need to make sure that there are people in the firm who can step up to the plate, replace the retiring owner, and take on that person's responsibilities. So let's take a brief overview of what I call key exit planning issues. First of all, the owner needs to identify their objectives. As I said, when do I want to exit? When do I want to give up ownership? When do I want to stop working? Those dates might be different. To whom do I want to transfer the business interest? Do I have certain financial planning objectives in conjunction with my retirement? Selling a business interest is sometimes a good opportunity to undertake other financial planning objectives. They might be charitable objectives, transferring wealth to family members. Importantly, we want to quantify what your resources are as you head into retirement. And that includes your liquid assets, investment accounts, retirement accounts, plus the value of the business. And we need to understand this thoroughly before you retire to make sure that you have enough assets to support you and your family in the style to which you become accustomed. We also want to undertake some planning to protect business value. That might involve strengthening your management team, finding ways to motivate and retain key employees, reviewing business operations to see what improvements, if any, can be made. We take two fork in the road here. We look at first ownership transfers to third parties. What are the issues involved with that course of action? First of all, we have to know, is the business or equity interest saleable? And we'll talk a little bit more about this and other issues later. Can the business survive due diligence on the part of the buyer? And of course, we want to look at some tax planning, a common theme throughout all these exit paths. For an ownership transfer to insiders, we need to do some leadership transition planning to make sure that there are persons in the firm who can step up, take on the management and leadership responsibilities in the firm. Financing becomes a main problem when transferring business interests to insiders. Again, tax planning. And we also want to engage in some business continuity planning. This is a critical area that business owners, especially owners of small businesses, frequently overlook to make sure the business can survive the death or disability of the owner and the value of the business does not dissipate in the event of death or disability. And finally, we want to emphasize the importance of time. I typically tell my clients that we need a planning horizon of 3 to 5 years to optimize your exit options. The less time you have, the fewer options typically are available to you in exit planning, and we'll see that as we continue. So I tell my clients 3 to 5 years. Many of my clients don't follow that advice. They are reluctant to start the planning process. And I'm showing here the results of a survey taken last year. Why do business owners not start the planning process? Well, they don't feel a sense of urgency. Other issues require attention. When I'm really ready, then I'll really take the necessary actions. I'm too busy. I need to stay in my business until I have enough money saved to retire. So all of these issues are present in the minds of business owners, and they all have some validity. But I would always tell clients and prospects, none of these issues should prevent you from starting the planning process. If you're not ready today, or you don't have enough money today to retire, well, that doesn't mean you should not plan for reaching the day when you'll be able to successfully retire. And putting a plan in place today that will allow you to exit successfully in 3 or 4 or 5 years is the best way to ensure a successful exit at the appropriate time. A list here of some issues, observations for architects from Lisa Henry, who is a consultant in the architecture industry. She's with the Greenway Group. Some points that Lisa makes. Owners can't emotionally let go. This is true for all business owners, applies to architects as well as everyone else. And sometimes the problem is business owners don't have a vision for what they're going to do after they leave their professional firms. There's a lack of business preparation for the new generation. You might have folks with tremendous technical skills and even client relationship skills, but they must have some basic business preparation as well. People who are ready to take over the firm don't have the financial resources to do that. Buy-ins or buyouts must occur over a period of time, and you have to plan for that accordingly. This number 5, I think, is of particular importance. Once employees have equity in the firm, they transfer loyalty from their own careers to the firm. And this is obvious, common sense, but ownership is a way to get your key people to actually become more committed, more loyal to the firm, and strive to make the firm prosperous and successful. Firm culture, top-down command and control type culture is not conducive for a good succession exit planning type program. And finally, how to value the firm. And this is an issue that we're also going to talk about a little bit later in this presentation. So getting down to nuts and bolts, how can firm owners exit? Well, there's only a few limited paths available. You can sell to or merge with another firm. You can sell to insiders, key employees or co-owners. You can sell to an employee stock ownership plan. And this is really a variant on the sale to insiders. And we're going to talk a little bit about this later because it's very popular among architecture firms. Or you can simply close up shop, liquidate the firm, or what I call dying with your boots on. Keep working until someday they have to carry you out of your office. So I want to spend a few minutes here to talk about choosing a successor. This is one of the critical decisions that you have to make early on in the planning process. And it's going to largely determine what the planning path is that you undertake. So smaller firms, the issue is there an internal successor? Or do you have to sell to a larger firm or merge with a larger firm? Do you have anybody in the firm capable of leading it after you sell your interest? Is there a culture to develop potential owners? Is there a financial plan in place that allows your younger professionals to acquire equity in the firm over time? If you don't engage in this type of planning, a sale to a larger firm or liquidation becomes inevitable. Larger firms typically have a program in place to develop new owners, and therefore an internal successor process is generally available, but sometimes larger firms decide that a sale or merger with a larger firm or another firm makes sense for competitive reasons. And when making this decision, which course you are going to follow, a sale to insiders or a sale to an outsider, you really need to understand ahead of time all the consequences of that decision. How is it going to affect your employees, your customers, your legacy in your community and the profession? All these things must be taken into consideration. Let's again talk a little bit about sales to key employees. Usually insiders, key employees don't have any cash. And Lisa Henry mentioned this as one of her observations, and that's a problem. But for reasons which we'll get into later, I don't consider it to be the biggest problem in sales to insiders. If you have people who can run the business and manage it successfully, there's usually a way to get financing. Can your key employees run the business? And just as importantly, do your key employees want to be owners? A key fact of business life. There are entrepreneurs and employees don't always want to become owners. And I've run across many instances in my career where business owners had lined up key employees as the eventual buyers of the firm, but then found out somewhat late in the process that those key employees did not want to take on the responsibilities of ownership, even though there was an opportunity for them to make substantially more money. And business owners frequently misjudge these issues. Business owners can't imagine that a good employee doesn't want to be an owner. And you have to assess whether those employees really are on an ownership track. Do they want to be owners? Are they champing at the bit to become owners? Or is that something that's really not part of their business horizon? Brief discussion of financing ownership transfers to insiders. I used to be a partner at a large CPA firm, and I know how CPAs think about these kind of issues. And typically, if you go to your CPA and say, I have a key employee who wants to buy my firm, how do I do this? The typical response is going to be, well, no problem. Just sell the practice for an installment note, where the key employee buyer is going to pay you over time, over 5, 8, maybe 10 years. I recently had a case where a CPA had recommended that a key employee buy out a business with a 12-year installment note. I tend to discourage that kind of transaction because it involves a great deal of risk for the selling business owner. When you sell for an installment note, in effect, you're dependent on your successor to be able to continue to operate the business successfully. And 10, 12 years is a long time to wait to get paid for business equity interest. And for reasons which, I'll mention briefly, there's usually a higher tax cost involved. So I generally work with practice owners to find a way other than a long-term installment note as a way of selling their practice. Better financing alternatives. Well, one of the more underutilized financing programs available is the so-called Small Business Administration guarantees. You can sell a business and get a Small Business Administration guarantee on a loan up to $5.5 million. And importantly, the SBA rules will allow a bank to lend up to 80% of the business value. So that means if you have a successor or a group of successors, they can borrow up to 80% of the value of the business, pay that to you at closing. SBA has some other important requirements. If there's a seller note for some of the equity, the SBA is going to require that there be no payments made on that note for 2 years. Now, interest can continue to accrue, but you're going to have to wait several years in order to get payments started on that seller note. But if you've already been paid for 80% of the business value, that's less of a problem. There are lots of other non-conventional financing sources available, and I've dealt with a number of them over the years. And typically, these other non-conventional financing routes will require seller financing in the range of 10 to 30%. 30% seller financing, in my view, is a heck of a lot better than 80% or 100%, which is what you get with the standard installment note. Again, to minimize your risk, you want to get paid as much as possible, as soon as possible. When you're selling or merging with an outside firm, a key advantage is the financial stability that that firm typically brings. In my experience in these types of transactions, typically you have 50% of the value paid at closing, and 50% of the earnout is managed over a 2 to 3 year period. Now, so in effect, you have 50% seller financing, but it's a much shorter term seller financing than a long installment note, and you're dealing with a much more financially responsible buyer who has the resources to make sure that they can pay you. The main challenges associated with these types of transactions are integrating the firm culture, employees, and clients. And those issues sometimes don't get enough attention in the due diligence phase. And I have seen transactions fail because of poor culture fits. So that's something that needs to be explored thoroughly before the transaction. Now, I've mentioned taxes a number of times, and we're not going to get into a lot of the details in taxes. Just a brief note, the recent Tax Cuts and Jobs Act that was passed in December of 2017 is highly favorable to architecture and engineering firms. There's a deduction available for 20% of the business income for pass-through entities and a very low tax rate for C corporations. This means that there's a lower tax cost for sales to insiders, and it also somewhat tends to reduce the benefit of some tax strategies, like using sales to employee stock option plans. Stock ownership plans. Okay, so why am I so concerned about taxes and transfers to insiders? Again, I'm just the big picture. If you sell your firm for installment note, how does that work? So you have a buyer who buys your stock in the business, and they're entitled then to receive the cash flow from the business. They receive that cash flow. They pay ordinary income tax on that cash flow. They take their after-tax proceeds and pay it to you as the seller, as a payment on the installment note. And you typically pay capital gains on those sale proceeds. And that means that frequently, the business cash flow is going to be taxed twice. It's going to be taxed as ordinary income when it goes to the buyer, and then as capital gains when it goes to you. And the tax strategies we consider here are designed to eliminate that double tax and minimize the overall tax consequences on the transaction. So various forms of qualified retirement plans can be used in conjunction with an exit plan for a retiring owner. Defined benefit plan, cash balance plans allow for large contributions on behalf of the owner, because typically the exiting owner is older and more highly compensated than the other employees in the business. So this is a way to put away a large amount of the company's cash flow in the owner's account. And when you make that kind of retirement plan contribution, there's an immediate deduction to the business. However, the recipient doesn't pay tax immediately, only pays tax when they make withdrawals from their qualified plan accounts. And they don't need to do that till they reach the age of 70 and a half. And those withdrawals can be deferred over a number of years. So you have an immediate tax deduction for the business, tax deferral to the recipient. And there are other types of retirement plan strategies that use the same basic concept. Okay, let's talk for a couple of minutes about business value. The value of a business essentially is the present value of future cash flows. Now, that's great. It sounds great on paper, but the key issue is, what are those future cash flows going to be? If I'm buying a business, I know what the historical cash flow of the business has been. But that historical cash flow is already in the pocket of the seller. The key question for me as a buyer is, what are the future cash flows going to be? And I need to estimate those cash flows. There's a very well-known IRS document called Revenue Ruling 59-60, which has become somewhat of an authoritative statement of valuing privately held businesses. And in that revenue ruling, my favorite part is the statement that business valuation is to some extent a prophecy about the future. So when I do business valuation work, I like to say I have to put on my prophet's hat in order to figure out what the future is going to be. Now, of course, we can make an educated guess about the future. How do we do that? Well, first of all, the recent history of the company is going to give us some indications about what the future is going to be. Has the company been growing steadily? Has it been showing weakness? Has it been declining? That tells us something about what we can expect going forward. What's the competitive position in the local market? Is there a particular specialization, a niche dominance, technical excellence of the professionals and the reputation of the firm in the business community, operational efficiency? These types of issues tell us something about the future success of the firm. Local market conditions and economy is very important as well. I have a client, an architecture firm outside of San Antonio, Texas, and they're a near suburb. I like to say they're only about 30 miles outside of San Antonio, and in Texas, that's a close-in suburb. But they're located in an area that in the last 20 years has begun to see very substantial commercial development, economic growth, and they've become a very well-established architecture practice in that market. And as that local area has continued to grow, the firm has grown along with it. And because the local area has the prospect of substantial future growth, we can reasonably expect that that architecture firm will enjoy significant growth as well. Now, a key issue here is is what I call transferable business value. What does this mean? A business can be very successful, be very profitable, but if you can't transfer that cash flow to a new owner, it only has limited value. Sometimes the business owner is so key to the success of the business that it's hard to replace that owner, hard to transfer that owner's skills and contacts to a new owner. I'll give you an example. I'm working with a professional services company now. It's very successful. It's a small firm with about 20 people. Annual cash flow is greater than $1 million a year, but it's led by an owner who has very specialized skills, and it's going to be very difficult to transfer those skills to a new owner. And for that reason, even though the firm is very successful and has a great deal of value to the owner, it doesn't really have that much value because it doesn't have transferable business value. Nobody is likely to pay a lot of money for that firm because the cash flow is not transferable. So we need a structure in place that will allow the firm to operate effectively without relying on the owner. You know, one question I like to ask business owners is, how long a vacation do you typically take? And sometimes I get a response, well, gee, you know, it's tough for me to get away for more than 2 or 3 days. Other people might tell me, gee, you know, I have a firm where I can leave for 3 months and be very confident the firm will continue to operate successfully. The first one, which is highly dependent on the owner, is going to have limited transferable value, whereas the latter, that can operate well without the owner constant presence, has much greater transferable value. Let's look at a few valuation and performance metrics for architecture firms. So these are some statistics that I'm going to give you, which are based on actual transactions in architecture firms over the last several years. So, and you have to keep in mind that these are average numbers, and the value of a particular firm is going to range very widely. So we have here the value as a function of gross revenue. So if an architecture firm has $1 million of revenue, on average, the value will be about 62.9% of that, or in this case, 629,000. But again, I have to emphasize that that value number is going to have a very wide range for particular firms. Value to what I call pre-bonus EBITDA. And what do I mean by that? Well, first of all, EBITDA is really a signifier of cash flow. It stands for earnings before interest, taxes, depreciation, and amortization. And pre-bonus EBITDA is cash flow before paying bonuses to the owner. Some firms will pay out all of the profits by way of bonuses to owners, and therefore their final cash flow number is going to be very low. But those bonus payments really reflect a distribution of profits. So when we look at pre-bonus cash flow, on average, a firm sell for about 5.5 times that cash flow. Value per full-time equivalent employee is about $115,000. Now, this obviously doesn't mean that you can increase the value of your firm by adding new employees willy-nilly. This obviously assumes that you have productive employees operating in an efficient manner. Some performance metrics. Gross profit margin. And what do we mean here? We mean revenue less direct labor costs and direct expenses. And a typical profit margin is about gross profit margin. That's before overhead expenses. It's about 65.9%. Revenue per full-time equivalent employee, about 140,000. Pre-bonus EBITDA, about 11.5% of revenue. Cash flow, about 11.5% of revenue. Now, this revenue growth number is what we've been seeing over the last 2 years, but 10.5% is an extraordinarily high number, and I think that that's something of an aberration. So even though that's what the numbers show in recent transactions, I don't think that that's a sustainable number. 5 years ago, we were looking at growth rates of 3%. 10 years ago, right after the Great Recession, we were looking at zero growth rates and declines because of the adverse economic conditions. Briefly, what about an ESOP? Again, an employee stock ownership plan. This is a qualified retirement plan that invests in the company stock. And the reason I mention it, because as I cite here, 40% of the ENR Design 500 are at least partly owned by ESOPs. And it's a very popular tool among large architecture and engineering firms. Now, there's really a size threshold, because an ESOP has very high regulatory and administrative costs. So it's not practical to do for a small firm. What is the size threshold? I suggest here 50 employees. Well, I've seen them done with as few as 35 employees, but below a certain threshold, the costs are too onerous for the firm to bear. So what are the advantages and disadvantages? Well, there are significant tax advantages. For a so-called C corporation, the owner can sell his or her shares to an ESOP and reinvest the proceeds in qualified securities. What's a qualified security? Really, any publicly traded U.S. stock or bond. So anything publicly traded on the stock markets or bonds issued by public companies. So you can sell your stock, reinvest in qualified securities, and the transaction is tax-free. You don't pay any federal income tax. That's only for a C corporation. For a so-called Chapter S corporation, well, an S corporation doesn't pay any tax itself. Rather, it distributes its income to its shareholders who pay tax on the S Corp's earnings. Well, if an ESOP owns the stock of the S Corp, so if you sell all of the stock in an S Corp to an ESOP, well, an ESOP is a tax-exempt entity. So that would mean that the business income of the S corporation would completely exclude income tax on an annual ongoing basis. Now, if you only sold 50% of the stock to an ESOP, well, 50% of the business earnings would completely escape federal taxation. So those are the basic tax advantages. An ESOP basically allows you to create a cash buyer for all or some of the stock. And there's a great deal of shareholder control. What do I mean by this? Well, the shareholders can decide, well, we want to now sell maybe only 1/3 of our stock to an ESOP, and we can retain the rest. And 3 or 4 or 5 years down the road, maybe we'll sell another 1/3. We can decide in total we want to sell 80% of the stock to an ESOP, and we can retain 20%. That is, it allows the ownership group to control the sale process and maintain control of the company even after selling to an ESOP by retaining some shares in the company. And of course, it also provides employee ownership and incentives. The owners want to make sure the company is profitable so that their retirement accounts continue to grow. As I implied earlier, the disadvantages are that it's a relatively complex transaction and there are significant both IRS and Department of Labor compliance costs, which have to be taken into account. Business continuity planning. So I want to mention this because many firms don't adequately address it. So you need a business continuity agreement. For multiple owner companies, this is relatively straightforward. You need a shareholders agreement, a buy-sell agreement, an operating agreement that addresses what happens to the ownership under certain circumstances, such as death, disability, termination of employment, if there's a dispute, retirement, a transfer to third party. And importantly, that agreement has to identify how the value of the stock is to be determined. For single owner businesses, there's really a special problem because you don't have co-owners who can buy out your ownership in the event of your death or disability. But we need to find an alternative business continuity plan. Sometimes we have agreements with key employees by which they will agree to step up and run the business for a period of time until it can be sold, or even other competitors or potential buyers will agree to do that. The important thing is to avoid the dissolution of the business on the death of a sole owner. We want to try to keep the business in place and going and on an ongoing basis, continue to operate, because we want to maintain the value of that business. We want to make sure the business stays together so it can be sold to the benefit of the owner's family. So just in conclusion, a few points. One of our concerns is getting the owners ready for the deal. Are owners emotionally ready to sell? Do they know what life is going to look like after the sale process? Do you have the right team advisors in place? Are you financially ready to sell? Again, I say this is not for do-it-yourselfers. Business owners are very good at running and operating their businesses, not so good at necessarily selling their businesses. It's something that typically they haven't done before and don't have the experience to do appropriately. Ingredients of a successful exit: written exit plan based on your objectives. I think it's very important up front to clearly understand what your objectives are, to establish a plan. How am I going to meet my objectives? You need some experienced advisors to help you design and implement the plan. And when I work with business owners, I always work with their existing advisors to the extent possible. I work with your financial planner, your accountant, your lawyer. Sometimes we need to bring in an outside specialist. For example, in the qualified plan area, sometimes we'll bring in an outside actuary to help design an appropriate qualified plan. You have to understand what the value of the business is and what the future cash flow looks like in order to plan appropriately. And you really need some good managers in place. this is often a problem for smaller practices. And again, this speaks to the issue of transferable value. You need to have people in place who can run the business in your absence. And finally, time. To do this kind of planning successfully takes some time, and that's why I urge you to begin the process several years before your planned exit from the business. So thanks very much. I appreciate your attention. We have some time for questions. Megan, I think.
Yeah, Don, I'm seeing one in the question box. It's what options are available to an architectural sole proprietor?
Okay, so there's a couple of issues. First of all, the business continuity issue. That really needs to be addressed by the sole proprietor. Because if you become disabled and you don't have any continuity plan in place, the business is simply going to disappear, and whatever value it has is going to dissipate. Secondly, the issue is if you don't have any people in-house who can take over the business, you typically are looking to align yourself with another firm that can find value in your practice and be willing to pay you something for that value. And structuring that kind of transaction becomes key.
Awesome. Great. And there is another one as well asking to please repeat the revenue ruling reference that you mentioned above.
Yes. Revenue ruling 59-60. It's those in the valuation business are very familiar with this revenue ruling. It's become a very authoritative statement that is used not only for tax purposes, but also for general valuation purposes and understanding how to value closely held businesses.
All right, I'm not seeing any more coming in, so if anyone has any more questions for Don that you think of later, please email him or me. I'll get it right to him. And thank you all so much for being on the webinar. And Don, thank you so much for presenting today.
My pleasure. Thanks,
so
Megan. Thanks, Megan, for organizing this, and thank the participants for listening.
Yeah, everyone have a great rest of your day.
Thank you.